Okay, hi everyone. I hope you can see me and hear me as well. Um, okay, so I think I've lost everyone for a second there. I'll just check to be sure.
But we can see and hear
Oh,
you.
okay, perfect. Okay, that's fine then.
I
I'll
see you
just go
at the
blind.
screen here. Okay, yeah, we can see you and hear you
Okay,
perfectly too.
okay, perfect. Thank you. So what I am presenting today is just actually an ongoing working paper. So this was a project I started a while ago, and then COVID happened. And so with COVID, many new questions emerged, and hopefully I intend to bring some of those questions in. So it's still developmental, and these are mostly preliminary results based on previously run analysis. But in essence, what I'm talking about today is the distributive effects of anticipated and unanticipated changes in monetary policy and stock market movements. And because it's the conference on monetary policy, I'm probably going to focus more on the results from the monetary policy angle, and perhaps also from the unanticipated changes angle as well. And I have been very kindly introduced. My name is Ruth Badru, and I'm so sorry that I cannot be there with you all in person. I was supposed to be in Toronto right now, but due to circumstances beyond my control, I am still here in the UK. Okay, so just in terms of the paper itself, so there are a couple main questions that I try to ask in this paper. And the first is, what is the effect of monetary policy on absolute versus relative income inequality? And how do these effects say differ if we were talking about anticipated versus unanticipated changes in monetary policy? And just to not allow for any more suspense, I will tell you what I actually find, even right now at the beginning. So what I do find from my analysis, or my preliminary analysis at least, is that the nature of inequality does matter. So if we're thinking of inequality in absolute terms versus in relative terms, the effect that monetary policy has on these sort of outcomes will differ. And specifically what I find in this paper is that monetary policy shocks seem to affect absolute income inequality adversely, no matter what kind of monetary policy shock we're talking about, whether it's anticipated or unanticipated, whether it's contractionary or expansionary, and whether it's in the short run or in the long run, which sounds really, really dire for any monetary policy user or policymaker. But in terms of relative income inequality, however, the story is a little bit different. We have varied results when we're talking of contractionary versus expansionary policy, and depends on the time lag of the analysis that we're looking at as well. And also, in many ways depends, at least this results depends, suggests that it may also depend on the time lag that it takes for the policy to come into effect, especially the outside lag. And this is one thing that I have found more recently in the extension of this paper, which I may not go into too much detail about today. But in any case, just before we go into how I come about these results and how I find out these very interesting or dire results, I think it's always good to talk about some stylized facts. And as the first speaker mentioned, we know that monetary policy is not often seen from the perspective of or seen as a tool that is supposed to have a core goal of reducing inequality. When we talk about monetary policy, at least people at the helms of affairs often think of it as a tool to stabilize the economy. So we're often thinking of income and wealth stabilization rather than redistribution. But that itself does not mean that monetary policy does not have an impact on inequality. And it can have quite a significant impact on inequality, as evidence in the literature would suggest. So even though the goal might be stability, it is still important for us to look at it from this equity perspective. And it's not so hard pressed, it's not so far fetched to think about this when we think about the fact that inflation affects our real money balances. I don't know if you all are experiencing the same thing in Canada now, but if you turn on the British news in the last month or so, you would either hear about the death of the Queen or you'd be hearing about the cost of living crisis. It's literally just the same thing on and off morning to night. And a lot of people are feeling the impact of the cost of living crisis because of the high rates of inflation. Even the British pound has gone to unprecedented lows against the dollar that hasn't been seen in almost half a century. So we're seeing, it's for the layman, it's obvious to see how inflation affects our real money balances, our purchasing power, how it affects the value of your financial or non-financial assets as well. And this is what we sort of think about when we think of Keynes's euthanasia of the rentier effect, as he tries to demonstrate. And one of the things that I want to actually talk about here is just when we think about um, policies that, when we think about the schools of thought anyways, that advocate for the use of monetary policy, it's often not one that thinks about how borrowers versus savers or lenders would be affected by using these tools of interest rates, for example. And specifically, when we think about exploiting the scarce value of capital, we're often thinking about the impact it will have on investment or economic growth or things that affect long-term macroeconomic outcomes or medium-term macroeconomic outcomes. But the truth of the matter is, if we're going to think about equality, then we may want to move more towards the ideology of Keynes, where we may want to be thinking of interest rates that are closer to zero and that sort of encourage holders of liquidity to engage in more purchases or spend ourselves out of recessions or things of the sort. So that there almost seems to be some sort of contrary goal in terms of what people at the helm of monetary policy affairs or people who use monetary policy tools would want to do with monetary policy versus if we're thinking about inequality and if we're thinking about welfare and bringing it to the more normative aspects of society or economics, it may seem like we have some sort of contrary goals here. And the question then is, how do we try to bring these two together? How do we try to maintain stability while also thinking about how this may adversely affect those who are on lower incomes or poorer households in our society? And if we think about it this way, just thinking about the fact that owners of capital or owners of financial or non-financial assets would often benefit more from certain types of monetary policy than those who mostly hold all their wealth or all their income in notes. You might, or in banknotes or in currency, you might imagine that when a monetary policy directive is announced or when a monetary policy shocks occurs in the economy, the effect on different types of households might vary. And the evidence from Dopey and Schneider here just demonstrates how richer households or pensioners might be more adversely affected when unanticipated changes in monetary policy happen or when we have things like surprise inflation. But of course, we also know that the alternative or the reverse can be the case where we see poorer households being affected because their money balances loses value. So what are some of the theoretical debates? What are some of the theoretical channels that you might use to kind of identify or describe this relationship between monetary policy, financial markets, and individuals' incomes? Just to note, because I can't see any video screen at the moment, but I'm manning the chat. So if you have any questions, you can direct them to me in the chat, or if you can hear me or anything. Okay, so when we talk about some theoretical debates, I wanted to bring out a few interesting debates that sort of link monetary policy, finance, and distribution together. And the four main ones that I've brought out here are the financial segmentation channel, the portfolio channel, the saving distribution channel, and the income composition channel. And when we're looking at this financial segmentation channel, it's sort of intuitive in the sense that we expect that, for example, expansionary monetary policy could actually serve to reallocate income in the sense that if you're dealing with market participants that are more likely to be richer or wealthier individuals who hold their assets in non-currency or interest-bearing assets or portfolios, we're likely to see that any sort of policy that affects these markets will probably have a higher effect on them than individuals who hold more currency. And if the portfolio channel is also related to that as well, in the sense that expansion in monetary policy may actually result in further consumption inequality, because we might be seeing a reallocation from low-income households to high-income households. The savings redistribution and income composition channel, on the other hand, are slightly similar as well. And the analysis here, or the main thesis here, is that when we have expansionary monetary policy, for example, or inflation that is brought on due to monetary policy shocks, what we would see is that savers might be more disadvantaged than borrowers whose the real value of their debt reduces. So, and similarly, when it comes to the income composition channel, we're also thinking about how individuals who hold financial assets in the financial markets are likely to be affected in periods of crisis, especially when these are not well insured against inflation. So what does the evidence suggest? So the theoretical debates that I just mentioned are themselves inspired by evidence in the literature. But if we're thinking about the evidence in the literature altogether, what we would see is that we know, depending, because many of us, I'm sure, do different types of research on inequality, whether it's relating to monetary policy or fiscal policy. I also do quite a lot of research on gender inequality. And I think one basic consensus that everyone in the room can agree on is the fact that income inequality has been increasing, not just in the US, but globally over the past decades. And while this is a fact, we do also know that there's some sort of disagreement as to how much inequality has increased, whether we are talking about pre-tax versus after-tax income, talking about annual versus lifetime earnings, or whether we're even talking about different types of inequality like gender versus, say, sectorial inequality, for example. So it becomes quite evident that how we think about inequality really does matter. How we conceptualize the effect on inequality of monetary policy tools or even fiscal policy tools does clearly matter. And if we think about the stock market as well, and while I will not focus too much on this in this presentation, I think it's important to also bring in that aspect of how asset holders, who are likely to be the top income earners or the top wealth holders in our society or in our economies, are likely to benefit from capital gains from the stock market more than poorer households, for example. And when the stock market booms, for example, due to monetary policy that has been affected that benefits investors in that light, you might actually experience a widening of the income inequality gap. So all of these things seem to be interlinked in a variety of ways. And even more so, evidence in the literature also suggests that, and this kind of just buttresses the point that I made earlier, that the bottom 60% of the wealth distribution, especially in the US, specifically in this case, virtually hold none of their income in financial assets. Most of them hold their income, whatever is left of it anyways, in currency. Whereas the 5% wealthiest households in the US hold 41% of their income in financial assets. That's a very, very stark difference. And there's a very stark reality that shows that whatever is happening in these asset-bearing markets is likely to advantage one sector of the economy compared to the other, especially the rich compared to the poor. So inequality becomes a very crucial becomes something to actually think about crucially when we are thinking about the effects of monetary policy. So while we want to stabilize the economy, is that stability, is that efficiency worth the potential equity gains that we might lose in that case? So this is why I said at times it seems like it might present some sort of trade-off, but I think that it is possible in many ways, and I'm sure many people will show that through their research and the rest of the conference, how monetary policy can actually serve both goals. And just to summarize some of the evidence that I have collected, some very early evidence that I've collected on this, we see that there is some sort of divergence in the literature. There are people who support, whose research or whose evidence supports that expansionary monetary policy widens inequality. There are those who say that contractionary monetary policy, in fact, but widens inequality. And vice versa, there's some who say expansionary monetary policy lessens inequality for specific types of households. And there are those who show a lessening effect on inequality from contractionary monetary policy. So the evidence seems to be varied when depending on the time frame of analysis, depending on, I suppose, also the countries that are used, the demographics. So there are a lot of different factors that cause a variation in these results. And another thing that I think is also not taken into note well enough is the differences between short run, medium run, and long run effects. And that is one of the contributions that this paper makes, trying to see how the effect varies when we look at different time periods of analysis, when we're considering different time periods of analysis. Okay, so just to, you notice I've been talking a lot about the US, and my paper really is based on is using US data. So the earlier version of this paper uses US data, but the more later version actually uses a panel of developed versus developing economies. And I would present some results on that, but it's not fully developed yet. But in any case, the time series data that I use for the preliminary analysis spans from 1960 to 2015, and the data sources are collected from a number of different well-known databases. So the general model, so in essence, what we're trying to think of is how our measure of inequality is affected by a range of different macroeconomic indicators. So inflation becomes a very key variable of interest here. We also include our federal funds rate, our market capitalization to GDP ratio, the Standard & Poor index, and the Wilshire 5000 index, because we're also trying to capture stock market movements. And we also think about employment in industrial occupations or in non-farm establishments. Just to mention here, when it comes to our measure of inequality, so we use the absolute Gini coefficient as a measure of absolute inequality, and we use the Palmer ratio as a measure of relative income inequality. Specifically, for those who are not familiar with the Palmer ratio, this just defines or it can be defined as the ratio of national income shares of the top 10% of households to the bottom 40% of households. And what we try to do is um, we try to see how those who have the highest income versus those who have the bottom income, how this gap is wide, and especially in the UK, for example, when we've noted that the middle 50% share of national income very rarely changes, often is stable over a very long period of time. And this is the case for many developed economies of the world. So this gives us a much more accurate measurement of the relative income inequality compared to our typical Gini coefficient. So in terms of the methodology, we employ three main methodologies here to address the research question. And the main one of which is our nonlinear ARDL model, so our autoregressive distributed log model. And after that, we go on to derive some impulse response functions based on the estimated VAR, and then conduct some Granger causality testing. I will focus especially on the results of the nonlinear ARDL model here because they prove to be more significant and consistent than the others. So in terms of the ARDL model, what we use here is a standard Pesaran et al. Model, and it's represented thus. However, we extend this further to use a more linear, non-linear approach. And the purpose of the nonlinear approach is so that we can identify the sort of asymmetric relationship that we're interested in. So we want to see how expansionary shocks in monetary policy versus contractionary shocks in monetary policy affect income inequality, but we also want to see the difference between anticipated and unanticipated shocks. So we want to also see how these dynamics play out in the short run and in the long run. And just to describe the methodology that we use here with the ARDO model, what we do here is just our betas and our t's. Our t's specifically here represents the rate of inflation. So the partial sum processes of our positive and negative changes in the rate of inflation, indicating whether monetary policy is expansionary or is contractionary, given the effects on the rate of inflation. And our W here represents our list of other deterministic variables, which I mentioned in the previous 2 slides, and of course our error term. And just to give you a quick idea of what our model looks like, the symmetric versus the nonlinear model, this is what it looks like before we run our analysis. And you see one of the main differences here between both models is, I don't know, I hope you can see my arrow on the screen, but you can see where we capture positive and negative changes in inflation using the asymmetric model. So here, for example, versus the linear model. So the asymmetric model allows us to capture unanticipated changes. The linear model allows us to capture anticipated changes in monetary policy. Okay, so moving on, we also employ VAR IRF impulse response functions just to see what our analysis looks like, or what a shock to monetary policy, for example, what effect that would have on our measures of inequality. Again, remember that we are comparing both absolute versus relative inequality, represented by our absolute Gini coefficient. Note that we're using the absolute Gini coefficient, not the typical relative Gini coefficient, versus the Palmer ratio. And this is what our Koletsky decomposition matrix looks like. We use the Koletsky decomposition to allow us to sort of triangulate these effects and these shocks specifically here. Okay, so this is a summary of the results. Of course, I'm sure you can imagine, if you're familiar with the ARDL model, the results table is a very, very, very long one. And so I've just tried to capture the highlights of the results here in these 2 tables. So this is our results. Our long run results are the ones with the L. Our short run results are the ones with the S. These are the results using the Gini coefficient, and these are the results using the Palmer ratio. Pardon me, I think I would just get a laser point pen just to be sure everyone's seeing what I'm doing. And in essence here, what you see is, and I will describe this result, I'll summarize it very soon, but what you can see is, using the Gini coefficient, we almost observe a positive relationship of both expansionary and contractionary monetary policy on absolute income inequality, whether in the short run or in the long run, and both results are highly statistically significant. And it is interesting because you would imagine that we may have varying results, but this is why I mentioned at the beginning that it almost seems like monetary policy really cannot win if we're trying to target, or if our goal is to reduce absolute income inequality. So we may need to find better tools. I'm just saying, maybe not, hopefully not. But the results from this analysis, at least for the US, indicates that this is what we're likely to see. But when we use the Palmer ratio, which is our proxy for relative income inequality in this study, we actually see varied results here. We actually are able to see that we can observe negative relationship with expansionary fiscal policy, positive relationship with contractionary fiscal policy in the long run, but then we observe almost reverse opposite effects in the short run. So there's some interesting things to unpack here, but just to summarize so we all get the full picture as clearly as possible. So with expansionary monetary policy, and we're focusing just on monetary policy here, with expansionary monetary policy in the short run, what we see is that this widens absolute inequality in the short run. In the long run, we also have the same effects. Contractionary policy, on the other hand, we also find that both in the short and long run widens absolute inequality. So this is what I mentioned before about the dire picture. However, when we start to think about relative income inequality, we find very varied results, which is interesting. In the short run, what we do see is that expansionary policy seems to widen relative inequality, and contractionary monetary policy tends to lessen relative inequality. So we're seeing more redistribution from the rich to the poor using contractionary monetary policy in the short run compared to the long run, where we are seeing a different effect. And with expansionary monetary policy, what we see is that this can have a lessening effect on income inequality in the long run versus in the short run. And I'm sure many of you are already also thinking about the argument of most monetary theorists and of the long run neutrality of money, or if monetary policy can actually have far reaching long run consequences. But according to our results, this is what we would suggest. And so just moving on to the VAR IRF. So you see this is a summary of the results. I have removed the rest of the shocks and relationships just to make this much more concise. And we don't really see very clear, statistically significant results here when we use a Gini as a measure of inequality. We do see a small, medium-term effect here due to inequality where there's a shock to, say, the federal funds rate. And we do see that there is a slight dip in our Gini, so a slight dip in absolute inequality, but even then, these results are not very highly statistically significant. And same thing here when we're thinking about stock markets. So that does bring to question as to whether or not these shocks really do have a long run lingering effect, or whether those effects persist over a long period of time. Similarly, with the Palmer ratio as well, we do not also see very obvious or very wide-ranging or very variations in our effect. However, what we do see here is that expansionary monetary policy will tend to lead to an increase in relative inequality, and this sort of tends to persist even though the effect is really minimal over a long run period. On the other hand, and as an aside, we do see that stock market changes may actually have a much more pronounced effect on inequality, relative inequality, from the short run and even into a longer time period. And then finally, hopefully I'm still within my time limit. And then finally, when we talk about Granger causality, what we do observe is a unidirectional Granger causal relationship here, working especially from the stock market to monetary policy. And while we don't observe any Granger causality from income inequality to monetary policy and to the stock market, we do also find that our relationship might imply that there might be some sort of exogenous relationship between income inequality and monetary policy, hence resulting in the inconclusive result of our short-run model. And then finally, when we look at the Granger causality results using our Palmer ratio, what we do observe is a unidirectional causality. And we observe this moving from the stock market to monetary policy, and also from monetary policy to income inequality, as well as from stock market to income inequality. So there might be some level of endogeneity here, and this may also be a question of trying to employ a much more robust diagnostic test to be sure that our analysis is our functional formula model is specified correctly. But in any case, there is some evidence to suggest that there is some sort of causal relationship or Granger causal relationship between monetary markets, monetary policy, and income inequality, especially relative income inequality. I will just stop here for now, and hopefully if you have any questions, I'm happy to answer them.